Welcome to Chapter 7, second part of the video. So in the first part, we covered most of the accounts receivables. And now I'm going to continue with this aging method, aging of receivables method. This is the one that companies actually use for their annual reports, and it's an extension of the percentage of receivables method. Then we'll talk about notes receivables, and we will briefly talk about disposal of receivables, and I will introduce one ratio called the accounts receivables turnover. Okay, so let me get to the right here, aging of receivables. This is the most precise method because in the previous video I said, well, the company estimates that 1% of its receivables will not be collected. But it's not really fair because it depends on the age of receivables. If it's a recent credit sales, then the chance of not collecting it is very small. But if it's an old credit sale that I have not collected, that it's been around for, I have not been able to collect it for more than, let's say, 2 or 3 months, the chance is the percentage is going to change, is going to be much higher. So instead of using 1% for all receivables, we're going to break up receivables into age groups, how long they've been past due. And we will be given a different percentage for all of them, for each group. So it will be all given to us. We will classify each receivable by how long it is past due, and each group will be multiplied by estimated bad debt percentages. The more past due, the higher the percentage, of course, will be. And then we will total them up, and we will follow the same steps. That total will be our desirable balance of ADA. We will look at the beginning balance of ADA, and then we will make an adjusting journal entry. So the accounts, when we use aging of receivables, you still debit bad debt expense, credit ADA. The accounts do not change. Just the way we calculate the actual amount will be different. So here's an example. These are the totals, right? So total receivables are $50,000. And then they're broken down into 1, 2, 3, 4, 5 groups. Not yet due, 37,000. Historically, what's the percent of receivables that are not due yet that we did not collect in the past? 2%. Up to 1 month past due, 5%. Up to 2 months past due, 10%, and so on and so forth. Anything over 3 months, look at the percentage. So it's 40% chance we will not collect it. So we take each group instead of the total, we take each group, multiply by its percent, so we get the amounts, we add them up, and then we total them up. So this amount right here is not an adjustment, right? This is a desirable ending balance of ADA. So I want my ADA, allowance for doubtful accounts, to be 2,270 after the adjusting entry. So then we will look up what's my beginning balance. If my beginning balance is credit, we subtract them. If my beginning balance is debit, we add them together. So here we are. The beginning balance is $200 credit. I want it to be 2,270. Subtract them. That's your adjustment. Plug it in. The accounts don't change. Okay, let's practice together. Let's go to page 345, exercise 7-7. This is not a hard method at all. Students usually understand it right away. Okay, so total receivables, these are 1, 2, 3, 4, 5 groups. These are different percents uncollectible. Let's multiply them, each group. So accounts receivable not due, I'm just going to take amounts from right here, $396,000, and I'm going to multiply it by 1%. Oh, it multiplies it for me, perfect. And then next group, $90,000, and I'm going to multiply it by 2%. So easy, I don't even have to use the calculator. And the next group is $36,000, and it's 5%. And 61 to 90 days past due, I have 18,000 of accounts receivable of that age group, and my estimated percentage is 7%. And finally, over 90 days past due, $30,000, and my estimate is 10%. Okay, that's my total, 11,820. So again, let me show you the T account, right? So the 11,820, this is what I want the ending balance to be. So let's see what my beginning balance is, and if it's, oh, there are two different scenarios. Perfect. So record estimated bad debts, assuming that allowance for doubtful accounts has 36 credit balance. Again, I'm just going to choose my accounts before even calculating because they do not change. Okay, beginning credit balance of 3,600. So 3,600 beginning balance. So what's my adjustment? I will have to subtract these two guys. So my adjustment is 8220. That's what we plug in, 8220. Hope it makes sense. Practice makes perfect. So right after this lecture, make sure to do your homework. 8220. Record the entry. The next one, record estimated bad debt, assuming that now ADA has $100 debit balance. So my beginning balance now is $100 right here. So I will have to add them together. If they're on the different sides of the T account, I will have to add, oops, these two accounts together. So this is my adjustment, 11,920. 11,920. I forgot to choose my accounts, bad debt expense, debit, ADA credit, and we are good. Let's check my work, and you can see that everything is correct. Okay. So that pretty much, guys, concludes our discussion of accounts receivables. I like this summary. So account receivables is an asset, ADA is a contra asset. Look right here, when we sell on credit, AR is increased. When we accept returns, or when we collect, or when we write off the actual bad debt, we will credit this account. ADA, when we adjust, we credit it. When we write off, we debit it. Okay, let's move to notes receivables. So, note receivable is an IOU. It's an actual written legal contract, and it's easy enforceable in court. So, compared to AR, I will require an actual contract to be signed, the actual note, for bigger amounts of dollars, for longer period of credit, for riskier customers, and I will charge interest. So these are reasons, these are examples of when notes are issued. You know, the customer had 30 days of accounts receivables. At the end of 30 days, they cannot pay. So I tell them, okay, I'll give you 6 more months, but I will change AR into NR, and I will start charging you interest. This is very typical. It's an extension of credit, but we replace AR with an NR. So you debit note receivable, you credit accounts receivable. So here's an example of a note. This is the date of the note. This is the period, 90 days. Guys, we will always assume 360 days, excuse me, per year. It's called the banker's rule, it benefits banks. So instead of 365, we will take 90 days over 360 days to figure out the maturity date. So July 10th plus 90 days. To calculate the maturity date, therefore, you need to know how many days are in each month, right? So July has 31 days. So 31 minus 10 is 21 days. So let me write it down here. So for July, I will keep this note for 21 days, right? 31 days minus 10, 21 days. In August, I also have 31 days. So 21 plus 31 gives me 52. 52. I need 90 days, right? Then we have September, that's 30 days, 82. All right, 82. So I know my note will mature in October, September, October. And guys, it will mature on October 8th. That will be the maturity date, because 90 minus 82 gives me 8. So October 8th, Notice it's not October 10th, right? If it's at 3 months, the maturity date would be October 10th. But since it's given in days, I need to do this calculation, so you will have to figure it out, the maturity date. Guys, this is the rate. It's an annual rate. So we're not going to get 12% because this note is less than a year. So we will get 12% multiplied by 90 over 360. So here they do the calculation, October 8th, I already showed it to you. Let's look at the journal entries. Oh, first, we use this formula in chapter 3. This is how to calculate simple interest. It's PRT. P is principal, $1,000. R is rate, 12%, or 0.12, I like decimals. T is time expressed in a fraction of the year, 90 over 360. So what's the amount of interest? 1,000 multiplied by 12% multiplied by 90 over 360, 30 bucks. So I will collect back 1,030, 1,000. So what do you collect at maturity? The amount of principal plus the amount of interest. So here is an example of a sale on a note. It's a riskier customer, Julia Brown. I don't want to give her accounts receivable because she doesn't have good credit or I never sold to her. So to protect myself, I'm actually making her issue and sign a note, and I will charge her 12% and I give her 90 days. So debit notes receivable, credit sales, July 10th. And then she honors the note. Oh, that's a different example, unfortunately. Okay, that's fine. So J. Cook has a $600, 15% 60-day note receivable due on December 4th. So we take PRT, principal multiplied by rate multiplied by time. So on December 4th, we're collecting a note. When the note is collected, it's called honored note. It was paid, honored. Debit cash, credit NR by the amount of principal, and interest goes to interest revenue. Now, if the note is dishonored, so J. Cook does not pay us, so we take 615 and we move it to AR. We say, you now owe me $615. Now, the problem is, and we talked about it in chapter 3 when we did adjustments for accrued revenues. The problem exists when the note is signed and issued in one period, and then it matures in the next period. So on December 31st, then I have to make an adjusting entry, and we did it in chapter 3, and we have to recognize how much revenue I earned. I'm not going to collect this revenue until next year, but I have to follow the matching principle. Remember, not matching, revenue recognition principle. Revenues have to be recorded when earned without regard to cash. So look at the example. On December 16th, we accepted 3,060-day 12% note from a customer. So on December 31st, how much of the interest do we earn? The formula is the same, just pay attention to the days. So December 31st minus December 16th is 15 days. Not 60 days yet, 15 days. I have to make an adjusting journal entry. Again, this is an adjustment right here, right? This is an adjusting journal entry. I take principal, 3,000, I take the rate, and I take how many days I had the note. Am I making this in cash? No, but I earned it, so it has to go on the income statement this year, not next year. What are my accounts? Debit interest receivable, not cash. I'm entitled to receive this, and credit revenue. So this amount then goes on the income statement, and my income statement is correct. What happens at the maturity? On the maturity date, I'm going to collect now full interest, right? 60 days worth of interest, which is $60. So I'm collecting 3,060, but look at your credits. You credit note receivable for the principal. You recognize revenue that belongs to next year. This is 45 days worth of revenue. So if you think about it, January and February, it's January is 31 days, February is 14. So this is 45 days worth of interest. Or simply full interest minus interest revenue from the previous period. And guys, this is revenue, this is receivable. So I matched revenue per year. $15 was earned previous year, previous accounting cycle, 45 is earned this accounting cycle. So it makes it to the appropriate income statement. Okay, so let's take a look at page 346 and exercise 7-13. Okay, honoring a note. November 1st, December 31st, April 30th. All right, so interest amounts, total through maturity. So what's the principal? $6,000, 180 days, 8% note. So principal is $6,000 for all of these examples, right? So this is total 180 days, total through maturity. This is just from the date I accepted the note, November 1st, through December 31st. So this will be for my adjusting entry. And then next period from January 1st to the maturity date, which is April 30th. So the principal doesn't change. The rate doesn't change. So the rate is 8% for all of them. But the time will change. So 180 days here. Let me go right here. Total through maturity, 180 days. November 1st through December 1st. So November has 30 days. So 30 plus, not 30, 30 minus 1 would be 29 plus 39. So November 30 minus 1, November 1st, that's 29 days, plus 31 days in December. That gives us 60 out of 360. And January 1st through April 30th. So January 31 days, February 28 days, and then March 31 days, and April 30 days. So together it will be 120 days. Or guys, simply 180 minus 60, right? Will be 120 days. And guys, total interest, so P multiplied by R multiplied by T. I already have the amounts, so total interest is 240. Adjustment for last year, the adjustment will be $80 revenue. And guys, here I can just subtract the two. So interest revenue for the next period will be 160. Okay? And now we're ready to journalize. So I accept a note, which means notes receivables goes up only by the amount of principal. Some typical mistakes, students start calculating interest when we accept the note. The interest does not come into play until the end of the fiscal period and maturity. And it's we granted a time extension, so accounts receivables are going down, 6,000. Okay, that's good. Record the entry. Make an adjustment. Debit interest receivable, credit interest revenue. And guys, we already made our, oops, not receivable, interest revenue. Interest revenue. There we go. And guys, we already made the calculation. So it's $80. It's interest for 60 days. And then White honored her note when presented for payments. So April 30th, we're going to debit cash. And cash will be debited by the amount of principal, which was 6,000, plus total interest, which was 240. And we will have 3 credits. It doesn't matter which one you list first. So let me list notes receivable first, 6,000 taken care of. Interest receivable from, interest receivable from last year, that was $80. And 160 is interest revenue for the current period. We are done. Record the entry and we are good. Check my work. Here you go. So you will have to make those adjustments and transactions. So let me go back. The next topic talks about how receivables could be converted to cash before maturity. This is the oldest method of financing business. It was happening even like in old Babylon, in ancient Babylon. It's called factoring. So receivables are amounts of money you're going to collect in the future. It's an intangible asset, but if you need money now, you can sell receivables to a factor. Usually a bank or financial institution, they would be happy to give you cash today, but they will charge you because they are now going to wait and collect your receivables themselves later on. And usually the charge, that factoring expense, is quite high. So I work for a business where we would sell our million of receivables today, and we don't have to wait because our receivables would not be collected for 6 months, 180 days. So the percentage we had to pay was often up to 25%. So I would only receive 750,000 in cash on a million of receivables. You can also, so selling receivables requires a journal transaction. Debit cash, debit that factoring expense, credit AR. Pledging receivables does not require a journal transaction, but you have to disclose it in the notes to your financial statements. And guys, pledging means you can use receivables as your collateral. Just like you can use your car or a house as a collateral for a loan, you can use your receivables as a collateral on any borrowing or debt or loan, and you disclose it. If I fail to pay this bond or this loan back to the bank, I will have to give up 1 million, 2 million of my receivables. Okay, the last thing, the AR turnover. This ratio shows how efficiently the management team collect, how efficient they are in collecting receivables. The formula is net sales divided by average AR. Remember, whenever you see the word average, calculate that first. Take AR current year plus AR last year, divide by 2. The higher usually the better, but when it's too high, it means that receivables are collected too fast, so my customers might not like it, and they might go to my competitors. So if your account receivable turnover is very high, this is how many times you collect per year. If it's very high, you can lose up, you can make your credit terms a little bit looser. If it's low, it means you're not efficient and you need to make your credit terms stricter, and you have to pay more attention to collections. Okay, that concludes chapter 7. Thank you so much.